Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, the 25th. My name is Eric Wilkinson. Yes, you very well may recognize me as the Wolfman from mainstream media, where I've talked about the economic, geopolitical, and market analysis. Well, I do those same things in these daily market commentaries, but I layer on top of it option strategies I find on any given day based on those assumptions I come up with that market analysis. It's the only way to really increase that overall yield in your portfolio. So play along with me as I talk about my trades, and then you can use that information to implement your own option strategies in your own portfolio according to your own assumptions. Also, please remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, with that out of the way, let's get it on with the economic data. Like I talked about, this week is going to be a pretty busy week for economic data, and it continues today, especially here in the United States, in the form of durable goods orders coming in at 15.8%, beating the street by the estimates at 10.3%. So durable goods orders, remember, that's going to be all of the manufacturing products that last basically over 3 years. We also got the core durable goods orders, which, what was that? Well, it's excluding transportation. I thought that they said that the initial, they must have made a revision to this. Anyway, it came in at 4.0%, expected to be 2.7%. The previous number was revised slightly down from negative 7.4% to negative 7.7%. So there is a star on that. They must have messed up on the original numbers. I can't remember what the original was this morning. Anyway, unemployment claims coming in worse than expected at 1,480,000, expected to be 1,320,000, sorry, and they revised the previous number down from 1,508,000 to 1,540,000. So both of those really not making this number look very good, even worse than expected there. We also got preliminary wholesale inventories coming in at a drawdown of 1.2%, expected to be 0.4% build. So we're seeing good numbers there. People are continuing to buy. You know, we've talked about the unemployment, people unemployed, but then with this unemployment plus the extra, some of those people are finding themselves with a windfall of money, making more money on unemployment than they were out there in the workforce. That is going to start coming off here very shortly. It's a question as to whether or not how we get these people incentivized to go back to work when they're making more money on unemployment. Well, some of that's going to fall off, don't get me wrong. They are talking about, you know, giving you a bonus if you actually find work. So a lot of people might start thinking that looks like a pretty good idea. Anyway, then we also got GDP coming in at 1.4%, in line with estimates there. And finally, we got natural gas storages was a drawdown of 120 billion cubic feet, expected to be 108 billion cubic feet. So storage starting to build there. Not a good thing. People aren't using natural gas, but hey, we're going into the summer. We should expect that people are going to be using less gas, right? You're not heating a whole lot of things when it's summertime and hot. But we did also see the crude oil inventories with a slight build yesterday. That did affect the markets yesterday. We got below that 9-day moving average over here on the chart for crude oil. Today, getting a bit of a bounce here. I don't think that we're going to be able to sustain much of a bounce again. Yes, we are in an upward trajectory here, but I think the market needs to roll back over towards at least $32 a barrel, maybe even test that handle there. So about $5 away on the upside at this point. Why? Because we're starting to see even like Disney starting to hold back on, or Disney World out in California starting to hold out on reopening. We're starting to see a lot of these places, even Disney talking about maybe holding off on the release of the new Mulan movie. All right, that's because they don't think people are going to be going to the theaters to watch these movies. So they're going to be holding back on some releases. AMC and some other movie theaters have talked about not making you wear a mask going into those theaters. Well, they've kind of switched that up. The reason why they didn't want you to wear a mask is because they want you eating and drinking, and that's where they make their money. They don't make money on the ticket sales. They make the money on the concession sales. That's where their real money comes in. And if you aren't eating and drinking, then you aren't making any money. Well, that being said, they've kind of switched that up and are tightening up that whole policy there, trying to figure out where the balance is, I guess. Anyway, that being said, we're seeing spikes in Corona across the United States as things start to open up. As a matter of fact, here in Arizona, I talked about it yesterday, it is starting to see more and more outbreaks happening here and around the United States, where other nations are starting to see some backing off of these outbreaks. That being said, we were stopping people from traveling here, and now people are stopping us from traveling there. That is going to limit people, obviously, getting on an airplane. Another thing is people aren't making these summer plans to travel to places like Disneyland because they aren't sure if that place is going to open up. So people aren't really making those plans, not spending that money, or not looking to travel. That's another reason why I think crude oil is going to be taking a tank here, because they're going to see a lot less travel happening. All right, gold futures down about $5.60. I decided to cover my GLD trade. It actually wasn't any worse off than I was yesterday with the rally, so we'll talk about that here in a minute. I may have missed it by a dime, but I don't really care. It's a winning trade, right? All right, bonds are up about 13 ticks on the day, and back into that area I've talked about, just getting above, yes, the value area. And when we get those value area highs, I usually talk about the market wanting to roll back over, but that point of control is so far down at 159, that is taking into account the old economy we had. We have this new paradigm that it is probably going to be slow for the foreseeable future. We've heard from the Fed governors, like yesterday we heard from Fed governors. They are talking they're going to keep interest rates low for the foreseeable future. Therefore, I think the bonds have more upside to this, back probably closer to that 180 handle I've talked so much about, and we will build in a volume node in and around that area. Maybe not the volume. I don't know if we're going to see as much changing of hands there, the actual trade happening, but at least complacency for the volume to build up around this area right here. And we can see we're very close, and I do expect that volume node to shift a little bit higher, but that's also lining up with about that 180 handle there. So I do think that we're going to go up in and around that area probably next week. I don't know if we'll necessarily see it anytime real soon. You know, we were seeing a lot of weakness in the equities. They made a rebound, and at one point, at least today, all across the board, the indexes were in positive territory after the Dow starting out the day down a couple hundred points. So move to the upside, not based on the economic data. Like we just saw, the economic data was not that great, aside from durable goods and core durable goods, which I guess is really what people are probably clamoring to, rather than the unemployment claims, which, you know, a lot of people are saying some of those unemployment claims were lagging and hadn't had the opportunity to show up in the system yet. And you know, there was places in Florida, I think there was 3-hour lines to get the unemployment. All right, here we have the futures. Now keep in mind, we can see the index when you're watching CNBC and stuff like that, that hey, the Dow's in positive, but Wolfman's saying that the market is in negative territory right now. Well, that's because the futures are forward looking. They are looking down the road. So when you see that happen, it really means that there is still some bearishness when that basis is higher than where the futures are trading. That means down the road, it's still looking a little bit more bearish. Now, we can say that we have had a nice trend to the upside. It looks like today with this candle that we've got going on here, that if we were to finish here, it would look like that candle right there has signaled at least a short-term bottom here. We are below the 9-day moving average, the 200-day moving average, but the market seems a little bit weak. There's a little bit more trepidation going on in the markets from what I'm seeing, and we may, yes, get a little bit of a bounce, but remember, tomorrow is going to be pretty key. We could see this look like a confirmation, but it's going to be the way the candle ends at the end of the day. And as we saw last Friday, the market really started selling off, despite the fact that there was a rush to the Hamptons. So it means like a lot of those weaker hands did not want to go into the weekend holding any stocks. I think we'll probably see something very similar to that going into this weekend as well, because of already starting to see some of these spikes in coronavirus. That is going to be a telltale that we'll start seeing come to fruition next week. So I don't know that there's going to be a whole lot of people wanting to hold on to stocks heading into the weekend. E-mini S&Ps were negative. Here we have the Dow Jones was negative. We got the NASDAQ slightly in negative territory on the futures. But again, yesterday we didn't get and stay below the 9-day moving average. Today we're just kind of treading water right above that. Now people like myself would say that that shows still short-term bullishness. Again, we might get a little bit of a bounce, but tomorrow's going to be a telltale, and we could get those counter-opposing dojis that I talk about so much. And if we get something like today where, we've had, sorry, I've got the black one up there. We've got a doji like this here at the top that kind of engulfed the previous day. Now today we get a doji that looks like that. Now that seems like there's a bit of a bottom. Now tomorrow we get anything that looks like this, where we kind of open up, rally, starting to make it look like, hey, it's a confirmation. Well, we're going to have to look at that candle at the end of the day, because something like this would signal that there is going to be something to the downside yet. And even if this doji kind of ends up like this as well, it doesn't matter if it's red or green, that is still kind of those counter opposing battles, and it will look like it's going to want to roll over. Now, obviously, if we end up to the upside that way, that is more of a bullish pattern going to reverse to the upside. So Friday is going to be a key day, especially for technical analysis like this on the candles, and any type of those types of setups are what we're going to be looking for to go forward. I've been, like I said, covering a lot of my positions, especially those longs. I wanted to kind of balance out my portfolio, get a little bit more delta neutral, which is what I've been doing throughout the days today as well. Kind of tidying up some positions that we'll talk about here in a moment. E-mini S&Ps is off about 9 points, but you can see up off the lows quite dramatically. We went down there, tested the 200-day moving average. It looked like we were going to start peeling back to the point of control and maybe even test that 3,000 mark. Well, that didn't quite happen. We started getting this rebound happening off the economic data, and now just above that 61 Fibonacci area that I was even talking about yesterday. That is going to act as support. Well, now we're above it again. That will act as support going throughout, but I do probably expect maybe a little bit more weakness throughout the day. The candle setups are going to be key going forward, and at this point, it's a toss-up. So I'm going to start thinning out my position, get out of some of those just long stock positions that I got into on this sell-off. Remember, I was selling puts into all of this. Now I'm starting to cover a lot of those positions, because I think that we aren't necessarily going to see these continue to move higher. I think that we're going to get a little bit more choppiness happening with the overall markets and start to see us kind of bounce in and around, whether or not, how that works out necessarily. But ultimately, I do think we're going to kind of chop around in and around a pretty tight range for the most part. That's not really a tight range actually, but you get my drift, is that the market is going to want to trend sideways going into the summer. Summer markets usually slow down, and that's where we will start to see some consolidation and maybe some volatility coming out of these markets. All right, And then let's get on to the daily chart of the E-mini S&P, or the daily breakdown of the E-mini S&P. Is pretty flat overnight. We're still on an inside day. As you can see, the value area today is lining up inside of the previous day's value area, and the markets just are pretty much trending sideways, despite the fact that it's felt very volatile, going from pretty negative to positive and back into the negative territory. The markets are just trying to work all of this inventory out and some of the weaker hands. Again, now back to the trades that I've done. Remember yesterday, I did a lot of, the last couple of days actually, I've had my MasterCard on where I've been doing covered calls against it, lowered the overall cost basis quite dramatically. Well, on yesterday's sell-off, I decided to, on the open, I was pretty bearish. I didn't want to have a whole lot of longs in there. On the upside, I covered some of my long, covered half of my position in MasterCard, but I had on a covered call position to cover that entire position. So yesterday, I covered half of that position and left on those short calls. Today, with the market opening up in and around where we closed yesterday, so it was a good move on that, despite the fact that maybe some people would say that I should have covered the entire long call or long stock position left on those short calls. I legged out of this covered call position, and I think I did a pretty good job on it. And with today's sell-off, I was able to get out of those long calls, which are in the July. I had sold the 330 calls in there, and I bought them back for 99 cents, where I originally sold them for $1.77. So that's overall lowering my overall cost basis still on the trades that I have. So that works out nicely, continuing to lower that overall cost basis. Now it's down around 230 something, where my position shows I'm long 270s. My overall break even on that is much lower from doing all of this cost basis reduction by selling calls, selling puts, dollar cost averaging, staying mechanical with our overall portfolio. And what does that ultimately do? Increases the yield in our overall portfolio, which you couldn't normally do by just going out there and buying stocks on any given day, pulling it out of the hat. Hey, today I'm going to go buy some stock. Well, by selling these puts, selling these calls against long stock, all of that stuff is how you can increase your overall yield over and above what you could do with like just regular investing. So that's what we try to teach in these daily market commentaries, how to do portfolio management a little bit more. And in the webinars, we drill down on these different option strategies we're doing, like the covered calls, the long put spreads, which is what we're doing today. As a matter of fact, that's what I'm getting ready for as we speak. I will be working on my presentation as we go throughout the day. I'm going to be trying to find some strategies that will fit a long put assumption or a bearish assumption, and then implement that long put. That's how we're setting up these webinars. We always come up with an assumption on our directionality on any given stock, ETF, or any other underlying. We have an assumption. In this case, we're looking at coming up with a bearish assumption and then finding the right strategy to fit that bearish assumption. It's not always just a long put. It's not always just a long put spread. So we're going to talk about the nuances of what needs to happen around that bearish assumption in order to implement a long put. So we're going to ultimately find our way to that. All right, so MasterCard. Now I just have on a long stock with a covered call strategy against it, and we're going to play that one out. If obviously we get up to 330, I would be more than happy to get out of this strategy. I'm not loving the financials, but today the financials started leading the way to the upside on this first move to get us back into positive territory. Now gold, I did cover my trade on this, and I didn't have it on for very long, but it was yesterday I was trying to squeeze a little bit more out of this trade, basically a 50% increase in my premium. But according to my rules that we will talk about today in the webinar on a long put spread, I decided to cover this to stay mechanical. And if you guys remember, it was just on the 15th that I decided I thought we were due for a breakout in gold, maybe break above those highs, even possibly test the 1800 in gold. Now this is GLD obviously, and it is the ETF. This has been waiting for a breakout to the upside, I believe, as well. I don't think that we're going to go to 10,000 or anything like that in gold, but I did think we were going to break above the previous high, which worked out quite nicely. And I went into the August, I bought the 160 calls, sold the 165 calls for paid $2.10 for that strategy to the upside. Now my rule is cover at a 33% increase in that. Now yesterday I was squeezing for a little bit more because it looked like we were going to continue that upside trend, but with today's market move, when I decided to cover this and the equity started making that move higher, I decided to get out of this for just slightly better than that 30% increase in that spread, and I ended up selling it out for $2.85. So just slightly better than 33% increase in that premium. So following those rules, that worked out quite nicely as well. That's all I've got for you guys. I am considering covering my LYFT trade, so I might as well talk about it since I mentioned it. LYFT had a big move to the downside, and if you guys remember, I have on the 35 puts in there where I'm long the August 35 puts. It is doing very well, and you know, it's holding above that 50-day simple moving average, but I do think that there is more weakness in this stock. So I'm going to play it out for a little bit longer. Any type of move to the upside, I will look to cover this, but I'm just not loving the space right now. I don't think a lot of people are doing ride shares. A lot of people are out there buying cars actually to replace what they were previously doing with ride sharing. So that's all I've got. A couple of things on my mind. Check out today's webinar on the long put spread. I'll go through all those rules in how we set that up, just like I did with this GLD trade, all right? There's times where we can do it and increase our probabilities of success, and we will drill down on this trade and some other trades that we might find out there for a bearish assumption. All right, so if you can't take that, check out our disclaimer. All right, make sure you guys go over this. We are an educational company. We are not trying to state you to buy or sell any of these strategies or underlyings that I've talked about. All right, take that.